It's a pleasure for me to welcome you to this presentation of Nykredit's interim result for the first half of this year. The first 6 months of 22 was marked by accelerating inflation driven by the global recovery after COVID-19 and the Russian invasion of Ukraine, which also has elevated commodities, food and energy prices and challenged supply chains. The half year was also marked by financial market turmoil and increasing interest rates level. That said, Nykredit today posted a very satisfactory result. David will walk you through the numbers in detail in a few minutes, but before we get to that, I will focus on 3 areas in my part of the presentation. First, I will speak a bit about the strong business result we delivered during the past half year despite the economic uncertainty. Secondly, I will speak about the development in our business from a volume perspective. And thirdly, I will turn to the economic environment we are operating in, to credit quality, and to our capital position. Let's begin with the results and turn to page 4. Today we have presented a very satisfactory result for the first half of 22. Overall, the strong result is driven by continued business growth across the entire group. Looking at the numbers, core income is up 7% compared to last year, driven by volume growth. The financial market headwind in the first half of 22 impacted our trading and investment portfolio income adversely and turned out a net result just below 0 for the period. Costs increased 4% compared to last year, driven to a large extent by higher staff costs due to increasing business volume and higher activity. David will elaborate on this later. Impairment charges was a net reversal of just over 220 million kroner, reflecting a strong credit quality of our loan book. We have reduced provisions for COVID, which hopefully is a thing of the past, and taking new provisions in light of the geopolitical unrest. The sum of these provisions for potential loan losses amounts to 2.3 billion Danish. We report a profit before tax of 5 billion kroner compared to a profit last year of 5.3. But the first half of 22 has indeed been very volatile, even by historic standards. Now please turn to page 5. As I mentioned, we have seen strong performance across all our business lines. In our lending business, we see volume growth across both mortgage lending and bank lending. Mortgage lending constitutes 95% of our total lending, and households are still the main driver of growth, with our partners in Nykredit delivering an increase in lending of approximately 40 billion since last year. In bank lending, we see a very strong loan demand from commercial clients, but household clients contribute to the growth as well. In wealth management, we have seen a strong client growth and positive inflow of new funds. However, assets under management has declined marginally compared to last year due to market volatility, which led to negative value adjustments. In recent years, we have experienced growth in our wealth management business as well as from our partners in Nykredit. This has gradually resulted in an income mix for the group that is more diversified than just a few years ago. With this brief overview, I will now ask you to turn to page 6. Let me continue with a few remarks on Nykredit's capital position, especially in view of the uncertain economic outlook in Denmark as internationally. We have significant reserves to weather any headwind that a downturn or a recession may inflict on us. First of all, our provisions for potential loan losses in the future are significant and include possible consequences of geopolitical unrest. Second, our loan portfolio shows a strong credit quality, and our customers remain very robust and liquid. Third, we maintain a strong capital position with a CET1 ratio of 19.8% by the end of the first half of this year. This is approximately 430 basis points above our capital policy target. And the capital excess is on top of our policy target that includes an internal stress buffer of 400 basis points. Finally, Nykredit has access to additional capital of currently more than 20 billion kroner from our shareholders, corresponding to roughly 485 basis points. It follows from our ownership structure with Nykredit as majority shareholder and the group of pension funds. David will explain our capital position more into detail, so please turn to page 7. The Danish housing market has slowed down after several years with extraordinary high activity and increasing prices. This significantly rising interest rates and uncertainty about the economy have started to affect the housing market. Property sales have decreased in the first half of 2022, and the number of properties for sale is increasing. The housing burden has increased in 2022. However, we still see the housing market as fundamentally sound. Unemployment is very low, and Danish households have a very high savings rates. According to Nykredit's latest housing market forecast, the market will shift to a lower year in the coming month. We forecast that house prices will decline in the coming period as higher interest rates, inflation, and market uncertainty impact the market negatively. We expect the house price decline will hit certain submarkets harder than the national average, as prices in these areas are very high and start to stretch. Please turn to the next page. Here on page 8, I will provide some additional context on our personal mortgage loan portfolio. Homeowners with floating rate loans and high LTVs are of course most vulnerable to higher interest rates and property price declines. The combination of very low interest rates and implementation of credit tightening measures in recent years have led to more homeowners to opt for fixed rate loans. 56% of Nykredit's loan book are fixed rate mortgage loans, providing homeowners protection from interest rate rises, but also securing the home equity in case of lower house prices driven by higher interest rates. Furthermore, households' ability to service their debt remain intact due to the strong household finances and low unemployment rate. You all know that high LTVs is equal to high credit risk. It is perhaps worth recalling that Nykredit and our partner banks in Nykredit operate a risk-sharing scheme where the partner banks bear the credit risk for the loan amount sitting above 60% LTV. Average LTVs have declined in the first half of 2022 and is now historically low. We believe that paying down your mortgage makes financial sense for young homeowners, and that only once you have reached a moderate loan-to-value ratio does it make sense to put amortization on hold. We therefore target our offering of interest rate loans to customers aged around 55 and above, and who have already paid off a large part of their mortgage debt. As you can see from the graph, we have made fewer of these interest-only loans than our peers. I will now turn to my final remarks, so please turn to page 9. We have posted a business profit for the first half of the year of 5 billion, which we, in light of the challenging market conditions, are very satisfied with. Core income from business with NLI, NFI, and wealth management income is up 7%, combined by growth in mortgage lending, bank lending, and wealth management. The result delivers a return on equity of 8.9% and a return on allocated capital of 12.1%, both after tax. Our credit quality remains strong. We continue to have sufficient buffers in place and have raised reservation for credit losses from 2.1 billion to 2.3 billion kroner due to the geopolitical uncertainty, which David will comment on later. For the full year, guidance for a business profit and profit before tax remain unchanged of 8.5 to 9.5 billion. This concludes my part of the presentation, and I will now hand over to David.
Thank you, Michael. I'll dig a bit deeper into our financial performance and credit quality. Let's start with the profit loss account on page 11. Net interest income is up 4% and has benefited from the very high. Net interest income is up 4% compared to last year, driven primarily by volume growth in our mortgage and bank loan portfolios. Our fee income is up 16% and has benefited from the very high remortgaging activity we have seen so far this year due to the increasing interest rates. Our wealth management business has had a good inflow of new funds, and wealth management income is up 6%. This despite financial market headwind and negative value adjustments, which I'll return to later. Trading and investment portfolio income amounts to a loss of 41 million kroner, primarily due to spread widening and negative value adjustments of the portfolio of floating rate covered bonds. Costs are up 4%, driven by wage increases, performance bonus, and compliance. Our impairment charges amount to an income of 226 million kroner and reflect strong underlying credit quality. This leads to a business profit of 4.3 billion kroner, and when we add the result of the legacy derivatives, we report a profit before tax of 5 billion kroner. Let's turn to page 12. As you can see in the figure to the left, net interest income is developing well. The growth of 4% is to a large extent driven by volume growth in mortgage lending and bank lending. As shown in the figure to the right, top right, we have increased mortgage lending by almost 5% or 64 billion during the last year. The growth is primarily driven by lending to private customers via our partner banks into Nykredit. In addition, we have seen an increase in the mortgage lending to corporates. Bank lending has increased by 21%. This lending growth is mainly driven by lending to corporates, both new and existing customers, as well as bridge financing. The growth is slightly above the Danish FSA soft law, the supervisory diamonds limit for lending growth of 20%. We do see the strong growth to corporates as positive and improving our already strong credit book. As the first among the largest Danish banks, Nykredit chose to raise our deposit rates immediately after the Danish Central Bank's interest rate hike. So our personal customers no longer pay negative interest on their deposits. At page 13, we look at our net fee income, which has shown a strong improvement of 16% compared to the same period last year. In banking, we saw lower fee income than we did last year, same period. However, the mortgage activity increased in the first 6 months of 2022 by gross lending amounting to 200 billion kroner. This is more than 40 billion higher than the same period last year. Due to the increasing interest rates, many customers chose to remortgage their fixed rate mortgage loans and thus reduce their loan principal. The high remortgaging activity gives rise to one-off fee income as well as higher funding income. Please turn to page 14, where we take a look at our wealth management activities. Wealth management income amounted to 1.2 billion kroner, 6% higher than the previous year, due to growth in average volumes. We continue to see organic growth, and new funds amount to 41 billion, or approximately 10% growth over the past year. However, asset under management was unchanged compared to the same period of last year, as the new inflow was offset by negative value adjustments due to the financial market conditions. Please turn to the next page. As shown in the figure, the trading and investment portfolio income reported a minor loss of 41 million. The loss is mainly due to credit spread widening that impacted the portfolio of floating rate covered bonds. Further, the positive value adjustments on the portfolio of strategic bank shares in the first quarter of 2022 were almost offset by the negative value adjustments in the second quarter. In addition, we saw positive value adjustments of derivatives due to higher interest rates. Next page, please. Looking at our costs, they are up almost 4% compared to last year. The increase is due to two overall factors. Firstly, costs mainly increased due to higher wages and performance bonuses. Secondly, we see costs related to compliance and growth as we invest in our most successful customer-facing units. Please turn to page 17. Here we look at our impairments, or should I say the lack of them. Fundamentally, credit quality remains strong. This is reflected in the fact that impairments post a net reversal of 226 million. Of the total loan impairment provisions of 2.1 billion made in 2020 to cover the potential losses arising from COVID-19, we have reversed 1.2 billion in the first half of 2022 due to reduced risk. Geopolitical uncertainty, including the war in Ukraine, are expected to affect the credit quality of certain customers as it curbs economic growth and causes rising energy prices and challenges in value and supply chains. We have provisioned 1.4 billion in first half of 2022 in response to these increased risks. In addition, we hold another 7 billion kroner in our loan loss reserves, which total 9.3 billion as shown in the top figure. Let's turn to page 18, where you can see the development in arrears on our mortgage loan portfolio, which constitutes the vast majority of the group's lending. We see no negative impact on our loan portfolio from the corona crisis. Currently, the rising energy and oil prices caused by the war, as well as increasing interest rates, haven't led to any losses this far, and arrears on mortgages remain very low. Looking ahead, the picture is certainly more blurred. Increasing property prices in combination with lower market value of mortgage debt and fairly high amortization rates have driven indexed LTV ratios significantly lower over the past year. We expect LTV ratios to have bottomed out. Now let's turn to capital on the next page, page 19. In relation to capital, I'll start with the development in the risk exposure amount, where we have seen 6% inflation since the beginning of the year. First of all, the volume growth in both nominal mortgage lending and bank lending has contributed almost 11 billion kroner in higher risk exposures. This is a logical outcome of our strategy and strong business performance in Nykredit and Nykredit. But the volume growth has been more than offset by improved credit ratings for our customers, as well as higher property values, which have improved the value of collateral securing our lending portfolio. In addition, higher interest rates have lowered the exposure due to the value adjustment of fixed rate loans. Altogether, these factors has contributed with a decline of 41 billion in REA. At the same time, implementation of new regulation and model changes have added some 42 billion to the risk exposures. In particular, the new guidelines from EBA from estimation of IRB models have raised our risk exposures from January 1st this year. The development in the financial markets in 2022 with widening spreads and high volatility have impacted market risk. Value at risk has increased significantly, and risk exposures for market risk are up so far by almost 11 billion kroner since the turn of the year. Please turn to page 20. Continuing the discussion on the regulatory development, a focal point is the implementation of the finalized Basel standards in the EU. In particular, how an output floor will be implemented. Nykredit has a strong capitalization with a CET1 ratio of 19.8% at the end of first half of this year. This is approximately 430 basis points above our capital policy target of 15 to 16%. This capital excess is partly due to a reservation that we have made for the expected impact of Basel IV. It's made under the assumption that the original recommendations of the Basel Committee will be implemented. When a political agreement has been reached in the EU, we will assess whether the capital reservation should be adjusted or not. Please notice that the IRB changes due to, for instance, new EBA guidelines that were presented on the previous page are effectively reducing the future impact of Basel IV. In terms of capital requirements, Denmark will rebuild the counter-cyclical buffer to 1% by end September this year and lift it further to 2.5% by the end of the first quarter next year. This will not affect our capital policy targets. The reason for this is that our capital policy targets already include an internal stress buffer of 4%, reflecting the impact of a severe recession. In a situation like this, we can expect the countercyclical buffer to have been released. Please turn to page 21. Before I conclude, let me just touch upon our funding plans. The requirement for us to hold at least 8% of total liabilities and own funds in bail-inable format entered into force at the beginning of the year. We have reached a steady state well in excess of the 8%, save for any addition to the requirement as our balance sheet grows. Our funding plans will therefore be driven by refinancing, and net new issuance will be driven by balance sheet growth. We expect to issue 5 to 10 billion kroner of bail-inable debt in the remainder of 2022. In covered bonds, we are currently conducting our quarterly auctions of shorter dated bonds. The offering amounts to 36 billion kroner. And now let's turn to page 22 for our final remarks. Let me conclude. We are reporting a very satisfactory results with a profit before tax of 5 billion. The good performance is driven by growth in all business areas. However, the result is impacted by the very volatile financial markets, and investment portfolio income was strained by negative value adjustments on certain covered bonds due to credit spread widening. Costs are slightly increased compared to last year, primarily driven by wage growth, bonuses, and investment in growth. We've been helped by zero loan losses, and our credit quality remains strong. We have raised our provisions for potential loan losses in light of the geopolitical unrest. And finally, as Michael said, our guidance from the year remains unchanged. We guide for a profit before tax in the range of 8.5 to 9.5 billion kroner. This concludes my presentation, and Morten, you can take over.
Thank you very much. As I said in the beginning, we will now open for questions. Please raise your hand in your Teams, or alternative right in the chat function that you would like to ask a question. And I can see that we have a question from Asbjørn Mørk from Danske Bank. Asbjørn, go ahead. I think we should unmute before. Yes, there you go.
Thank you and good afternoon. Two questions from my side. First, relating to credit quality or loan loss provisions, as you also touch upon a bit in your presentation. What exactly should we be sort of looking for as a trigger for higher loan loss provisions going forward? Is it going to be a house price declines, or do we need to see a fundamental and significant increase to unemployment, or sort of if you can just give us a little bit of flavor on what we should sort of be worried about? Thanks.
I think that we are probably looking into house price declines of 5 to 10% until the end of next year, but still with a very low LTVs, and with the agreement that we have with our banks, we are quite positive still on when we're looking into our private household portfolio on bank and on mortgages. So I think the biggest risk is of course what is happening in macro wise, because I think that some house price declines, maybe also the financial markets turmoil will probably affect, you can say, the demand in the society, and therefore there could be some risk from that. But I think actually, not talking only about Nykredit, but in total, the main risk is probably on the corporate side, small and medium-sized corporates which are depending on exporting to Germany, and so that could cause something there. And of course, if the situation will turn into a higher degree of unemployment in Denmark, it could also affect, but still we see very high employment there. So I think the main risk is on the corporate side, small and medium size, where we are not that big in that part of the market. So I know that we can discuss the risk scenarios, and we all see some very actually high uncertainty. But seeing that uncertainty turning into, you can say, loan loss reserve issues, that still remains to be seen.
You had a second question, Asbjørn?
Yes, thank you. It goes on your ROAC target and return on equity targets, the 7.5% that you lowered it to last year when rates were negative, and you said peers were struggling as well to have decent profitability. Now rates are on the rise, has already come up quite a lot, and at least on my math, your NII sensitivity is rather large. So just wanted to basically hear your thoughts on return on equity targets for the Nykredit Group going forward in the current or future interest rate environment versus the environment we have been through.
Thank you, Asbjørn. We don't have any plans to change the new target of 7.5%. And as you say, of course, the interest rates environment has changed. On the other hand, as you also know, there are no loan losses at all right now. At some point in time, I guess we'll see a normalization of that. So we'll stick with the 7.5%.
Okay, thanks. If I just may follow up on that, does that mean that the 7.5% is completely unrelated to market rates in general? So if rates go even further, you will not look at the ROE target at some point in the future?
We look at it all the time, but for the current, we don't have any plans to change it.
All right, that was a clear answer. Thank you.
Thank you. As I said, if you have questions, please raise your hand, or you can also write in the chat for me. If you're participating on audio only, you are of course welcome to just shout basically. But we have a question from Sverre Holbæk. Please go ahead. The line is open.
Yes, thank you, Sverre Holbæk from Danske Bank, and thank you for taking my question. It's just on your funding target. You are guiding for 5 to 10 billion DKK. To be issued in the remainder of 2020 and 22, and I believe that is slightly down compared to your previous guidance of about 10 billion DKK. And not having issued anything in the meantime since Q1, I was just wondering what that adjustment, what that can why that is there.
Yeah,
Thanks.
But that's basically down to the fact that the market value of our mortgage loan portfolio has decreased. Driven by the higher interest rates, which of course drive down the price of especially the 30-year fixed rate callable covered bonds, and since everything is fair value on our balance sheet, lower total assets actually means a lower funding requirement for us. So we have that effect on our balance sheet, and that is why we are now guiding for slightly lower funding requirement for the remainder of this year. The flip side of that is, of course, that if we suddenly see interest rates declining significantly in the long end of the curve, that funding need can of course come back. We don't see that as an imminent risk, but just to point out that we have that volatility in our funding requirements. So that's why.
Thanks, makes sense. Thank you.
Are there other questions? I saw another hand, but that had been removed again. So I guess we answered that. Are there other questions? Please raise your hand, or if you are, as I said, participating on audio only, you are welcome to speak up. Yes, there we are. Edward Dimitri, you are welcome. Please go ahead.
Yeah, thank you very much. Edward Dimitri from Danske Bank. This is perhaps a bit of a specific question in relation to the Nykredit business. Obviously, today we've seen many customers on the 3-year fixed get hit by quite an increase in their in their interest costs, and it's basically really related to concerns the bank might have about customers and their ability to pay down these costs. So I really want to ask about what the exposure is really to these customers, and is there a concern for other customers that might be refinancing after being on a very low and fixed rate cost for some time in the short term?
I can't remember the exact amount of that loan, but I'll come back. I'll come back to you on that from I think it's in our fact book. When we do our stress scenarios on our customers across different loan types, we see generally very strong economic positions, and we, without being too unconcerned, as Michael also said, when we look at it, we're not that worried as long as we see employment at the levels we are right now. We can actually see a quite large stress both on what they pay on interest rates, but also on gas prices and electricity and so on. So I think we have a quite strong customer. So no, we're not that worried, even though of course for the individual customer it's a big hike that we've seen on this auction.
I think it's also fair to say that most of these customers have in the past experienced significantly higher interest rates. So yes, they have had quite a long period with extremely low interest rates. However, it's probably more a question of adjusting to the levels that they had in the past, more than it comes as a complete shock to most of them. But there are, of course, customers that have been, so to speak, starting off their career as mortgage clients with extremely low interest rates. But they have been underwritten under the assumption that they can cope with an interest rate of 4%. That is a very important thing to keep in mind. That all customers on our balance sheets have actually been approved under the assumption that they can pay 4% interest rate.
Thank you very much. That's clear. Thank you.
I think we have an additional question from Asbjørn. Go ahead.
Yes, thank you. Just to follow up, so the current government is proposing this rental indexation rule of 4% for rental residential clients. So just wondering if you should have a limitation on the indexation part, it could have a negative impact on the cash flows for your exposures or your collaterals in your rental residential exposures. So just any comments on how that could impact your first of all the collateral values, and secondly the potentially loan losses or capital requirements would be interesting. Thanks.
I think it's Michael here, Asbjørn. I think we have not been able fully to investigate and analyze this. First of all, it's difficult for us, and we dislike, you can say, to comment on political moves here. Secondly, I still think whatever the outcome might be, I still think the net effect will be quite limited to us. I have difficulties to see that it will really impact our loan losses.
Also remember that the LTVs are historically low, so I fully agree.
Okay, thank you.
I don't see any other hands, so this is fair warning. If you have questions, this is the time to raise your hand, or as I mentioned, if you're on audio, speak up. I don't see any more questions. I think that concludes the call. If you should have any follow-up questions, you're of course, as always, welcome to reach out to the investor relations team, and we'll be happy to help you and guide you. Thank you very much. Have a nice evening.